Welcome to the sixth episode of the complete learning series of stock market, trading and investing. As always, I put the complete series into a playlist. The playlist is available up here in the I button. Make sure you watch all the videos in the right order. Let's learn really well, trade together, invest together and grow together. So in this series so far, where have you reached? Now you have a basic perspective about the stock market set really right. You have some really basic understanding of how the stock market works, and in the very last video you have opened a demat account for yourself. Now you've also done something practically and you're all set to start your journey in the stock market. So now that you are in the stock market, you're learning about the stock market, you have a demat account opened for you, what all can you do? Now, I know you know the answers because we've already learned this in the first video. What can you do in the stock market? Number one is you can do long-term investment, right? You can invest for the long term in the stock market. Number two is you can do trading in the stock market. Probably a lot of you are super excited about trading. Now, we've already learned it. I'm just giving a quick recap of what we learned. Why do we do long-term investment? We invest for the long term to grow our money, right? This is the intention why we are doing long-term investing. And why do you trade? We trade so that we can generate an extra income for our life. Now, as I said in the initial video, this is super important for everyone to be super clear, which is long-term investment is a necessity. I believe everyone should invest for the long term, but trading can be a choice. I mean, some people or someone can trade, someone might not trade. It's absolutely okay. It's not necessary for everyone to become a trader, but it is super necessary for every single Indian to invest for the long term. I hope this is clear. Now again, some more clarity I want to give here is, when we speak about long-term investment, all you do is you buy stocks. You buy stocks or shares of good quality companies. You take delivery of these stocks and you store them in your demat account. You've opened a demat account, right? So you take delivery. That's a very important word, delivery. You take delivery of a stock and you keep that in your demat account for a very long enough time. That is what you do in long-term investment. Now, when we speak about trading, trading is done for generating income. So in trading also, as you can see, there are two types of trading available. Number one, what is this? Intraday trading, right? Probably most of you got attracted to the world of stock market probably hearing about intraday trading. You would have seen a lot of screenshots, people showing, hey, I made 5,000 rupees, 10,000 rupees, lakhs of rupees in a single day. You would have heard the term intraday trading. That would have got you excited. You would have come into the world of stock market. So in trading itself, there are two different types of trading. Number one is intraday trading and number two is positional or swing trading. You need to be very clear. So what I'm trying to convey here is, let it be intraday trading or let it be positional or swing trading. What are we trading on? Yes, we would buy and sell stocks. We would also trade on futures and options. Now this is very clear, or this should be super clear to you. When we speak about trading, let it be intraday or positional or swing trading, we are doing that on stocks or futures and options also, in both intraday and positional or swing trading. Now, as I said in today's video and in the coming few videos, our aim is to get more information around the logistics about how to do what it is, or about long-term investing and trading, both intraday and positional or swing trading. Is this clear? I'm just setting a bit more perspective. This is the agenda for today's and the upcoming videos. So to be very clear, what is today's video's agenda? To understand everything that is there to long-term investment. Okay, we'll understand that in today's video. In the upcoming videos, we'll understand everything that is there to trading. Okay, so again, to set today's video's agenda clear, the table of contents in today's video, we are going to understand what is long-term investment, why long-term investment, how to select stocks for long-term investment, why do stocks price move with time. Number 5, what are the logistics behind when you try to buy a stock for the long term? What happens in the stock market? Where do you get these stocks from? We are trying to understand the logistics there. And finally, we are also trying to understand how to measure your long-term investment journey as going. If it's going right, how much returns are you able to make? All of those things. So this is what we are going to understand and try to learn in this video. As made very clear, long-term investment, everything that you need to know about it, we are going to make it super clear in this video. So as I always say, if you're still a beginner in the stock market, maybe an intermediate trader in the market, if you're still not able to make consistent profits from trading, then don't hesitate anymore. Go down, download MarketFeed app, where you can get real trades of India's most top profitable traders for free. We're not going to charge you anything for that. You can join their live trading sessions. Also, you can learn their secret trading strategies directly from them. So that's it. Without further ado, let's get right into the video. The name is Sharique Samsudheen. Welcome to Market Feed. Okay, so before we start learning, there is a small disclaimer. The fact that when you start watching the video, you might feel this video to be super simple, super basic. But as I said, as the video progresses towards the end, there is a bit more complex concept for you. And again, it's not just about this video, the whole learning series about investing and trading. As this progresses, the complexity of the series, the learning concepts would also increase step by step. So don't worry, make sure you watch the video completely. Okay, so as I said in the introduction before, there are 6 segments to this video. Let's enter the first one. What is long-term investment? Long-term investment is when you like a company. You think that a company has good potential, good growth potential, and it would grow in the coming years. You like a company, you buy its stock, and then you hold on to the stock for a considerable enough period of time. That is what long-term investment is. Now you may ask me, what is this long enough period of time? I would say minimum some number of years, 3 to 5 years, and a maximum of even 30, 40, 50 years. That is what long-term investment is. So when you do this, what you basically do is you go to the stock market, you take delivery of the stock of this company that you like. So when you take delivery, the stock actually comes into your demat account. It stays in your demat account for the whole period of time you are staying invested into the company. And maybe after some good enough period of time, after maybe 10, 20 years, you are seeing some good growth in your money, right? The money you have invested, because the company has grown, your money has also grown. So when you see that good returns at some point of time, you can decide to sell that stock. When you're selling that stock, the stock will go away from your demat account and you would have made that capital appreciation. Now this is what long-term investment is. Now let's enter the second segment of this video, why to do long-term investment. So there are 2 reasons why you should be investing for the long term. Number 1 reason is probably the reason that I have said multiple times to you. You probably already know this. The number 1 reason is for capital appreciation. That is basically to grow your money, to create wealth for yourself, right? Capital appreciation. The second reason why you should be investing for the long term is to get dividends. If you remember the first video about the basics about the stock market, we did discuss about dividends there, right? Dividend is when a company declares profits and divides this or distributes this profits to the shareholders. So if you're an investor in a company, if the company is profitable, the company will distribute profits to you, and even you will get the profits in your bank account. So that is dividends. So these are the 2 reasons why you should be investing for the long term. Now, since we are learning a bit more deeper, let's discuss a bit more about these 2. Number 1 is to grow money, to grow your wealth, or for capital appreciation. Now, is it necessary that you will or your money will grow if you invest into a company and wait for a long enough period of time? I can only look into historical data and speak. What is most necessary when it comes into long-term investing is that you invest into good quality, high quality stocks. Now again, let's keep stocks aside for some time, right? Let's speak about how NSE and BSE has performed over the last 20, 30 years. If NSE and BSE, the complete stock market has only performed well, then it means that most of the stocks have only performed well, right? Now you tell me, how can we see if NSE and BSE has grown or has gone down over the last 20, 30 years? What can we look into? You got an answer? Yes, we can look into the indices, right? We can look into Nifty 50 to judge the performance of NSE, and we can look into Sensex to judge the performance of BSE. Now, on the screen, you are seeing the charts of Nifty 50 and Sensex over the last many years. What can you see here? There are some dips here and there. At sometimes the graph is going up, then it is coming down. But if you are looking at a very long enough period of time, right? If the time horizon is long enough, can't you see that they're only going up? There are some small scale fluctuations happening here and there, but in a long enough period of time, they're only going up. Which means that majority of the companies, majority of the stocks prices have only gone up when the time horizon is long. Which means that when you're investing for the long term, if you're investing into multiple company stocks, most of them will only go up. Some of them might not do well, but in the end, if you are staying invested for a long enough period of time, thus long-term investing, you'll only make money. Now, that is a very general example I took, right? Let's take a specific example. We all know the company TCS, right? From the house of Tata, TCS. So in 2004 is when TCS did its IPO. So 2004 TCS did its IPO. If you would have put 1 lakh rupees into TCS stock then, today it would have been over 15 lakh rupees. How amazing, right? Now TCS, if you would have done enough research, if you would have liked the company, if you would have thought the company would have grown, you just put money. 1 lakh rupees into it, it would have been 15 lakh rupees. The same 1 lakh rupee, if you would have put in an FD, now it would have been only over 2.5 lakhs. See what the difference long-term investing is doing to your investments. How amazingly it is allowing you to grow your money for capital appreciation. So the whole point here is, if you are able to identify good stocks, good companies which can grow in the upcoming years, then the growth would only happen gradually. Thus, long-term investment. So you shouldn't expect the fact that you're investing into a company and the very next year you're going to make huge returns. It wouldn't happen. Do not be worried about small-scale, short-term fluctuations in the price. You believe in the company, you stay invested for the long term. And speaking about tens of years here, minimum, so that you can actually enjoy capital appreciation. I hope that's super clear. Now let's talk about the second point, which is dividends. Now, here is a list of companies which are paying out good dividends for their shareholders. Now again, just before I explain the concept of dividends, right, where a company, when it generates profit, it distributes the profit generated to its shareholders. Now, when you invest into a company for the long term, you are a shareholder. So if the company is distributing profit, you will get that as an income. Now, every year, if this company is distributing profits as dividends, you as a shareholder, you will be eligible to get that profits. Now, that acts as a cash flow for you. Every year you are getting dividends also. Now, when you're invested in the company for capital appreciation, this is a bonus you're getting, right? Every year you're getting some money as dividends also. So, when you invest in a company for the long term, you get capital appreciation. Along that, you also get dividends, which makes long-term investment amazing, right? Now that you understand the awesomeness of long-term investing, let's move ahead into the next and the third segment, which is how to select stocks for long-term investment. Speaking about how to select stocks to invest for the long term, there are two things that you should know here. One is what stock to invest in, and number two is when to invest into that stock. So what helps us in understanding what stock to invest in, or what is a stock which is good or which can perform good in the coming days, is fundamental analysis. And the second thing, which is when to invest into the stock that you're interested in, what is helping us there? It is called technical analysis. These are two different sets of studies. Fundamental analysis is another study. Technical analysis is another study. Let's talk about fundamental analysis first. What did I say? In order to understand which is a good stock, what is a good company, you have to do fundamental analysis. Now, the term itself is self-explanatory, but still I'll use a very simple story and example, as I always do, so that you can understand what fundamental analysis is. So, for example, let's take a friend of you. He was working somewhere, he is doing well for himself, but then he quit his job. And then he comes to you with a business idea. He is pitching his business idea to you and is asking you to invest into his company. What would you do? What would you do? Actually, logically, maybe pause the video and think about it. What would you do? You would fundamentally analyze his business, right? You would look into who he is. Does he have the capabilities to run a business? What is his background? Does he actually have the right skills to run this business? Then you'll start thinking about the business also. With all the business knowledge that you have, even the slightest business knowledge you have, you'll start thinking about, is this business really right? Is this idea really good? Does this business have a good market here? Or will he be able to pull this off, right? You would think some basic stuff here, and then you would reach a decision, right? Oh, no, my dear friend, I don't think I would be able to invest into this business. What did you do here? This is actually called fundamental analysis. You actually fundamentally analyze the fundamentals of him, the business owner, and his business idea that he proposed. Now, this is what fundamental analysis is. For example, you take a company like Reliance. How can you analyze if this company is good or not? Now, when it comes to the world of stock market, there are some technical, complex stuff that you can do in order to learn about the business that Reliance does. Now, since Reliance is a publicly listed company, Reliance statutorily has to publish its annual report every year. Now, what is this annual report? Annual report is a 300 to 400 page document which tells everything that is there to the business that Reliance is running. Everything about the team, everything about what Reliance as a company did last year, what it is planning to do in the company in the coming years. You can know everything about the company. What is even more interesting is that in the annual report, all of the financial statements of the company would also be there. Financial statements mean the balance sheet, profit and loss report, and also the cash flow statement of the company. What more do you want? You have all the numbers regarding the business, not just about the current year, but also from the previous years. You can collect from the previous annual reports. So you can have an absolute understanding of how the company is doing financially. Is that growing, or do they have prospects to grow more? You can do all those studies. Also, by reading the annual report, you can also get more clarity on what the operations, the exact operations of the company is. Now, when we speak about Reliance Industries, you know Mukesh Ambani runs the company. You know some basic understanding. They do something about oil and all. Then they have this Geo company. They also have some retail wing. But do you exactly know from which business they are making how much money? What exactly their operations are? Everything to the dot you can know about the business of that company if you read the annual reports well. Now, what more do you want? By doing so much study, by reading the annual reports, by asking around, by knowing more about the management about the company, you can know everything, or you can form a judgment about the company, right? You can decide whether the company is good or not to invest for the long term. Now, what is this called? Fundamental analysis. Now, I know maybe at least some of you, when you heard annual reports, 300, 400 page, balance sheet, profit and loss statement, maybe you would have felt a bit intimidated. You would have felt like, okay, this is not meant for me. Let me stop learning here. Please don't do that. That is exactly why I am here for, right? In the coming videos, probably the next week, we would start learning about fundamental analysis. We would actually take an annual report of a real public company. We'll go through that. We'll learn together how to study about a company from its annual report. We'll even dive deep into its financial statements and even learn. I'll make things very simple for you. I'll tell you what is important to look into, what is that to be ignored, and I'll teach you how to do fundamental analysis in the most easiest manner. So don't worry at all. So the whole point here being how to select stocks to invest for the long term. You do a basic fundamental analysis to understand if the company is good or not. Now, say you understood a company is good and you want to invest into the company. Now the question is, when do you actually buy the stock? When you feel that it's a good company, do you actually go into the stock market and buy the stock? I would say if you really want to be a good investor, don't do that. Do the second thing here, which is technical analysis. When you do technical analysis, you'll understand what is the good time to buy a stock and what is a good time even to sell a stock. So what is technical analysis? Again, if I only speak about some basics here, it's difficult to speak about basics only because it's another complex, huge world where probably after a few weeks, we'll start learning about technical analysis. We'll dive deep into that also. But here, if you see, now what you are seeing on the screen is called a chart. A price chart of a company, price chart of Reliance itself. Now, as you can see here, price keeps on fluctuating. Now, if you look into the chart, you are not able to understand anything. But if you learn technical analysis well, you will have enough skills to know what is a good price for the company to invest in. From where will the price of a company go up? So technical analysis basically helps you understand the price chart of a company in a good enough way so that you will have, or you will know when is a good time to invest into the company. So when it comes to technical analysis, you will have to learn about candlesticks, candlestick patterns, chart patterns, and a lot more technical indicators and a lot more. Do not be intimidated by that also. The whole point again of this course is that we'll move ahead and we'll learn about them as well. So again, to sum this up, how do you select a good company to invest in? You do fundamental analysis to select the company, and you do technical analysis to decide when to invest into the company. The fourth thing that we have to learn here is what factors drive the price of a stock. Now, from the previous videos, we already know why the price of a stock keeps on moving every single second. We've already learned that, right? What is it? Demand and supply, right? So the last traded price is what we see on the screen as the price of a stock. So if you go into any trading terminal, as you can see here, every second the price of a stock keeps on moving every second. It might go up, it might go down. What is that price that we are seeing there? Is the last traded price. Maybe someone bought the stock and someone else sold the stock to him. What was the price in which this deal happened? That is the price that we are seeing on the screen. So every second the price of a stock keeps on fluctuating. Now if there is huge demand for the stock and very less supply for the stock, what would happen? Basic logic of demand and supply, right? The price would only go up because the sellers would demand more money. Which are the suppliers? Suppliers are only less, right? These are the sellers. They would demand more money, and since there are more buyers, they would be okay to pay that money. So the price of the stock would go up. Now, when would the price of a stock move down? When there is huge supply. That is when the number of sellers are more and the demand is very less. Number of buyers are less. So there are a lot of people who want to sell this stock, but no one is willing to buy only. So the sellers would say, okay, now we'll lower the price. At least then you buy. Then some buyers would start buying. So price would start moving down. So this you understand. Because of demand and supply, price keeps moving up or down. But again, then what we are trying to understand is in this segment of this video is what decides demand and supply for a stock. Two reasons here. One is fundamental reasons of a company, and number two is market sentiments. Now, number one is very easy. If you speak about the fundamental reasons of a company, again, very related to fundamental analysis that we talked about. If you actually see, if all the market participants are seeing that Reliance as a company, it's doing well year on year. Profits are only going up, revenues only going up, they're coming out with new initiatives. The company is absolutely growing in terms of fundamental numbers, profit, revenue, everything is going up only. What would happen? All of the people in the market would feel that, hey, the company is doing really well, so the demand would only go up. Supply is anyways limited. Supply is the total number of shares available, right? That is anyways limited only, and more people want to be a shareholder in the company, and the price would only naturally go up, right? That is how fundamentally, when the company grows, the price of the stock would go up. Now, in the opposite case, fundamentally, if the company starts doing bad, if a company, the debt is increasing, right? The debt is increasing, bank is coming, income tax rate is happening, revenue is going down, hugely going down, they're actually going into loss. Year after year, the loss is actually widening. What would happen? People wouldn't appreciate that company. People wouldn't want to hold on to the stock only. People would start selling. So, since the company started going down fundamentally, the price would also start going down fundamentally. I hope you understand that. Very important to understand that concept. Now let's come into the second reason, which is market sentiments. Now this is very interesting thing because this is where people feel the stock market is a bit of an interesting place. That is, even if nothing changed to the company's fundamentals, if the company is staying there only, the next day the revenue did not grow, profit did not change much. But maybe the next day itself, the price might increase some 5, 10, 20%. There can be a sudden increase in the price of a stock. Why? Because market sentiments can change. Now let's take an example here also. I always take examples and stories to teach you. Right? Example can be of Tata Motors. Say Tata Motors is a company, it's trading at a price. One sudden day, they came out with an announcement that, hey, we are going to go all into electric vehicles. We are going to set up India's largest electric vehicle factory. We are also planning to start operations in other countries also. Now, what sort of a sentiment would this drive? All the participants in the market would be like, okay, in the coming years, electric vehicles are going to be the thing, and now Tata Motors going to lead that race is an amazing thing. So people would feel that, okay, this company is good, let's start buying. So there would be demand only because of market sentiments. Nothing has happened there for the company, right? Only because of market sentiments, people would start buying and the price of the company will start moving up. Understood? Fundamentals did not change. Just because market sentiments changed, price started moving up. Now, after 3 weeks, Tata Motors is like coming out with a press release and saying that, okay, we went a bit overboard earlier with the with our announcement. Now when we do the study, it seems that we might not be able to do that in this financial year. We are still on track only. Maybe we might do it only after 5 years. For the next 5 years, our focus would still be on the older generation of cars. How will the market react to this? Now the market will be like, hey, Tata Motors has no clear vision only. They are not thinking clearly. They said something else earlier. Now they are going to focus on older generation. They're continuing to do that only. What would be the market sentiment? People wouldn't be happy, right? They'll be like, all of those people who bought earlier and maybe even investors from earlier times, they would start selling. So there would be larger supply and less demand and the price would start coming down. Hope you understand the point here, right? So stock price normally moves only because of demand and supply. But what defines demand and supply are these two reasons. I hope you understand this. So these are the reasons why stock price keep moving all the time. Now the fifth thing to understand here is when you buy a stock and try to take delivery of that stock into your demat account, what exactly happens in the stock market? Where do you actually get the stock from? That is what we are going to learn in this segment. But for that, we have to actually get back into our classroom, into the whiteboard. Let's go there. So here, we are going to understand what actually happens in the background when you are trying to buy a stock and get it delivered into your demat account. Now, basically, two types of buying a stock or taking a delivery of a stock. Number one is the primary market transaction. I hope you remember what primary market transaction is. That is, when during the IPO, initial public offering of a company, you're applying for the IPO and then you get IPO allocation, right? In that case, if you get IPO allocation, then from the company's shareholding, the share moves into your demat account. That is super clear. Nothing more to be understood there. So in terms of a primary market transaction, the share moves from the company's ownership into your demat account directly. There is nothing more. A broker sits in between and helps you go with the whole IPO application and allotment. Super clear. Now, this is where we have to understand what happens in a secondary market transaction. That is, after the IPO also, the stock is going to be there in the stock market and you are a buyer. See, you are a buyer who would like to buy that stock from the stock market. Now, what happens in the background? Let's take an example here, right? Now, say you are a person with 1 lakh rupees capital and you are interested in buying Mahindra and Mahindra, the very popular automobile stock, right? So, Mahindra and Mahindra's current stock market price is nearly 1,000 rupees. You have 1 lakh rupees with you. So, in that case, you can buy 100 shares with the 1 lakh rupees, right? 100 into 1,000 is 1 lakh rupees. So, you can buy 1,000 shares. Now, you want to do that. So, what would you do? You would go into your broker's terminal, you would search for Mahindra and Mahindra, you would punch in quantity as 100 and you would say that, you would tell to your broker that you are interested in buying 100 shares of Mahindra and Mahindra. What would the broker do? Broker will go to the stock market with that information of yours. And what is the stock market? NSE, right? National Stock Exchange of India, or BSE, Bombay Stock Exchange. So anyways, the order goes into the stock market. What happens in the stock market? Order matching algorithm. That is something which is available in the stock market. So what I'm trying to say here is, this is the whole sea of the stock market in India. There are multiple stock market participants. Each of these red boxes shows stock market participants in India. Now you have said that you need to buy 100 shares of Mahindra and Mahindra. Now, out of these lakhs of crores of stock market participants in India, there would be some people, not all of them, some people who would want to sell Mahindra and Mahindra shares at the same point of time when you say that you want to buy it. Correct? That is called liquidity in the market. There is so much volume, so many people in the stock market. When you want to buy something, there would be sellers. If there is no sellers, you wait for some time. There would be someone who comes in to sell it, and then those orders get matched. So they tell that they want to sell it via their brokers, right? These sellers tell that they want to sell Mahindra and Mahindra via their brokers. So that order also comes into the market and these orders get matched and you get your Mahindra and Mahindra shares that you needed. Now, for example, you said that you needed 100 shares and maybe the seller one is only selling 50 shares of Mahindra and Mahindra. This person is selling another 30 shares of Mahindra and Mahindra, and this seller is selling another 40 shares of Mahindra and Mahindra. So what happens? So this 50 you get, this 30 you get, and from him you take only 20. So these orders get matched with your order and your 100 shares of Mahindra and Mahindra you get. Super clear? Very easy only. So when that order gets matched, what happens is from their demat accounts, the shares of Mahindra and Mahindra moves into your demat account. Right. So when does this actually happen? So here also you need to know something technically called settlement date. So let's say that the day you punched in the order is called day T. Day T. So T plus 1 is the day when you will actually get delivery of stock in your demat account. So if you actually punch in an order today, you will see the stock in your demat account only T plus 1, which is tomorrow. So I've seen a lot of people who actually bought a stock and on the same day they don't see it in their demat account, in their holdings tab. So they are kind of worried, hey, where did my stock go? Do not worry at all. Settlement period in the market is T plus 1. That is when you buy a stock today, you will get its delivery tomorrow only. Do not worry at all. So now you understand the logistics, right? When you buy a stock, it comes from other people in the market. If there is no other seller in the market, it's called there is no volume or there is no liquidity in the market. You wouldn't be able to buy at all. If there is volume or liquidity in the market, there are people willing to sell it in the market, then you will get it via order matching algorithm. Super clear. Now this has happened. Now you've got 100 shares of Mahindra which you really needed in your demat account. You hold on to it for a good enough period of time and you made some money there. The price from 1,000 rupees went to 2,000 rupees. After say 3 years, the price went up from 1,000 to 2,000 rupees. Amazing, right? You made a profit of 1,000 rupees on the stock. Now you want to sell this stock. What would you do? You'll again go into a broker and you will punch in a sell order. You will punch in a sell order at 2,000 rupees for 100 number of shares. So that order again goes into the stock market. In that case, there would be buyers here. And if there are enough buyers, the order will go through and the 100 shares will go into them and their money will come into you. Very clear? And now one thing you have to understand, which is regarding technicality here, is when you sell a stock, on the same day itself, the stock will go away from you, but the amount you're supposed to get, 80% of that amount you'll get on the same day, 20% you'll only get on the next day. That is on T plus 1 is when you get the 20% of the fund. Super clear? So this is the logistics, or this is what exactly happens in the background when you are buying or selling a stock. So far you have understood so much about long-term investing and I'm sure that you are really excited to do long-term investing. Seeing here that you bought a stock at 1,000 rupees, it went up to 2,000 rupees in 3 years. Your money has actually doubled in 3 years. You want to do it, right? All of you should do it. But when you actually do it, practically after doing, shouldn't you know or shouldn't you have a means with which you can actually calculate your returns or you can actually see how well you're doing? You should definitely do. That is the sixth and the final segment of this episode, measuring your performance. Basically, what you do here in the stock market is investment. You're investing your money in order to grow your money. So when you're doing that, you have to mathematically know what your return on investment is. Otherwise, what is the point? You put in some 5 lakh at some point. After some 5 years, you're getting 6 lakh rupees. How would you even know if that is good or not? If that rate of return or return on investment is good or not? So that is why earlier, if you remember, we always used to talk about benchmarking, right? If you invest into mutual funds, you're going to get 15 to 18% per year. If you're putting your money in fixed deposit only, you're going to get what, 5 to 7% returns every year. So these percentages are return on investment. So whenever you're doing long-term investing yourself, you have to calculate the return on investment of your investment. Only then you can benchmark and you can know if you're doing well or not, right? So speaking about calculating your return on investment of one stock investment you did, there are two ways to do this as well. The first way is the rookie way of doing it. A lot of people do like that, and that is not the right way to do it. Still, I'm discussing it because you might do that, and I really want you to know that that is not the way to do it. The second method, which I'm going to explain today, is how it should be done. Let's talk about the first method, which is the wrong method, which is looking at absolute returns, absolute percentage returns. Say in this case also, let's actually do a absolute percentage returns calculation and see how wrong that is. Say in this case, Mahindra and Mahindra share you bought for 1,000 rupees. You bought 100 quantities, total investment was 1 lakh rupees. So after 3 years, the stock price went to 2,000 rupees. So your total investment went up to 2 lakh rupees. So 1 lakh rupees went to 2 lakh rupees. So how would you do the calculation here? You can see the formula here, right? This is the very basic formula a lot of the people use, which again is very wrong, right? So what they do is 2 lakh minus 1 lakh divided by 1 lakh into 100, which gives 100% returns. That is true, right? Your money has effectively doubled. So this investment has actually given you 100% returns, which is true. Factually, theoretically, this is true. But is this helping you in any terms? Because when you look into Nifty, we say that Nifty gives 15 or 14% returns every year. If you speak about FD, it gives 6% returns every year. But here it is 100% returns over 3 years. That is, the time is not same everywhere. If you want to compare this return on investment with a Nifty investment or some other investment, if you want to do comparison, then the unit of time should be same every year. Here you are saying 100%, but the time horizon is not clear here, right? It is over 3 years, but it should be, or comparison should be always done with similar time horizons. That is exactly where we have to look into the second method of measuring your return on investment, which is by using CAGR, compounded annual growth rate. Now, the name might seem a bit complicated, but here is the formula. The formula also might seem a bit complicated, but it's super simple. You just have to take the values from this example and put into it and do a calculation. Do a calculation yourself. In the formula, you can see that there is 1 divided by number of years, right? Which means that the time horizon, the perspective of time also comes into this calculation, right? Did you do the calculation? I'll help you. You can go to Google, you can just type in CAGR calculator. Some website will come. You just put into the values of Mahindra & Mahindra story which we took and you'll get the answer. Did you get? Yes. It's 25.9%, right? This makes a lot of sense. So this example where your 1 lakh rupees investment over the period of 3 years went to 2 lakh rupees, which basically doubled, the CAGR returns is 25.9%. That is, every year your money grew 25.9%. Now this is great. So if you use a CAGR method in order to calculate your return on investment, that is the best way to do it, so that you can compare it with other benchmarks, other return of other investments, and with every other comparisons possible. So that is the best way to measure your return on investment. Now we have come to the end of this video. I know this might have become a bit lengthy. This was a bit of basics, but again, it gave you more understanding about long-term investment completely is what I believe. And there were a lot of terms, scientific terms that we use in between, jargons that we use in between. Now our aim in this learning journey is to go ahead. As I said, probably the next week itself we'll start learning about fundamental analysis. Maybe after some more weeks we'll start learning about technical analysis. Now you know what is there in this world, at least the terms and all. Later we'll learn more about these terms in depth, so that we can be really good investors, really good traders, right? So that is it from my side for today. As always, make sure that you like this video, and even more importantly, make sure that you go into the comment section, speak to other people, right? Ask me questions, help others, talk to each other. Make sure the comment section is super active. As I always say, this is not just a very simple learning course that I'm doing here. We are trying to build India's the very best stock market community here. So that is what we are trying to do. And as I always say, make sure you invite your friends, your family, all the people you know into our learning journey together. And for that, share this video with them. I strongly believe that all of you would do all these things. So as I always say, let's learn, trade, invest, and grow together. See you in the next episode. Bye-bye.